If you make $65,000 a year, just how much home can you afford at today's interest rate of 7.125? Or what if rates went up even further to 8%? What about then? Well, that's what we're going to cover today. We're going to run through a few payment and affordability scenarios using an FHA loan product. You may be asking, well, why FHA? Well, FHA loans have the most leniency in terms of debt to income ratio, down payment, and credit scores. Before we get into the good stuff, my name is Nicole Rueth, founder of the #1 loan origination team in the state of Colorado. If you enjoy this content and you want to see more like it, do me a favor and hit that thumbs up button. And feel free to subscribe to my channel to stay updated on everything real estate, mortgages, and economics. FHA loans are one of my favorite products out there because they give home buyers, especially you first-time home buyers, the opportunity to get in today's market. If you didn't know, you can purchase a home using FHA with as little as 500 credit score. But if your score does fall between 500 and 579, you do need to have at least 10% down. But anything above a 579, you only need to have 3.5% to put down. So for example, if you're buying a $300,000 home, that's $10,500 down. That 3.5% is on the purchase price. Additionally, FHA allows you the most lenient debt to income ratio at 55%. I've seen it go as high as 57 or 58 even, which is quite a bit higher than conventional loan options. Now, this is where I do have to throw in a disclaimer, because there are a few requirements that you have to meet in order for FHA to approve you. Just because you have a 500 credit score and 10% to put down doesn't mean you're automatically going to be approved. As we go through today's calculations, please keep in mind that you will always want to be talking to your mortgage professional about your specific situation. This is not me telling you that you're going to get approved no matter what. All right, so let's get back to the monthly payment calculations. If you make $65,000 a year, again at today's interest rate of 7.125, with the possibility of rates increasing to 8%. And I know you may be asking why I'm not going lower. And that's because the reality is rates are going to remain higher for longer. So for the sake of time, I'm not going to get into why that is. But I will link a video down below that I made talking exactly about why interest rates could be into the sevens throughout next year. Of course, buying a home right now and in this market isn't for everyone. But if you're considering it, getting insight as to how much interest rates affect your monthly payment and affordability is a great first step. In order to calculate how much home you can afford, we first need to calculate how much income I, as a lender, can use to qualify you. Your income and your debts are used together to calculate what's called a debt to income ratio, which for this example, using FHA, we're going to say does not exceed 55%. So with that in mind, looking at your gross monthly income, meaning that income, your income, before taxes are taken out. For the sake of simplicity, we're going to assume that you're a W-2 employee, because then we can essentially take your yearly income and divide it by 12 to get your gross monthly income. So we're going to take that $65,000 a year that we started with, and we're going to divide it by 12 to get a gross monthly income of $5,417. So if I take the $5,417 gross monthly income that you make, and I multiply that by the 55% debt to income ratio, that tells me that you have an availability of $2,979 for all of your debts, consumer and house. So I deduct your consumer debts, the $500 a month car payment that you have, the $200 in your student loan payments, which leaves me with $2,279. That's important because that means your monthly housing payment cannot exceed that. Your monthly housing payment is your principal and interest, the property taxes, the homeowner's insurance, the mortgage insurance, and the HOA. So they can add up. So keep in mind, this is just one example, and all the calculations can change based on your specific financial scenario. A great thing to note about FHA is that should you have a lower credit score, your rate is going to be better than conventional loans. I mean, I'm using 7.125 on a conventional loan today, they'd be higher. But the mortgage insurance does stay with you for the life of the loan. So that's the one downside, unless you are able to put 10% down. Then you're going to get a lower interest rate and your mortgage insurance will fall off after year 11. So you're wanting to buy a $275,000 home, let's call that a townhome or a small single family home, with a down payment of 3.5% or $9,625. That equates to a loan amount of $265,375. FHA also requires an upfront mortgage insurance premium on every FHA loan, which is 1.75% of the loan amount. Now, you can either choose to pay this fee up front at the closing table, or you can finance it in for less out of pocket. In this case, that upfront mortgage insurance premium equals just over $4,600. If you're financing in that cost, your new base loan amount now equals $270,019. At today's interest rate of 7.125, that means your principal and interest mortgage payment is going to be $1,819. Adding in property taxes of 0.7%, that would be about $160 a month. Plus, on top of that, you have mortgage insurance based on a 0.55% factor. That's $125 a month. And lastly, homeowner's insurance, which we'll estimate at $75 a month, along with an HOA of $100 a month. This grand total brings your total mortgage payment with everything included to $2,279. So in theory, your $65,000 a month income qualifies you with the $700 in consumer debt exactly for that $275,000 townhome. As mortgage rates increase and affordability tightens, we often look at what debts we might be able to pay off prior to closing, or getting a non-occupant cosigner, or including that gig income that you've been doing on the side for the last couple of years. Alternatively, we have first-time homebuyers who choose to stick with that budgeted payment that works for their finances. So as rates go up, purchase prices need to be adjusted lower. All of that said, here's where I want to land the plane. While interest rates do have a significant effect on affordability, they should not be the end-all in your home buying journey. I understand that they sound scary, and that was a lot of numbers. But what you should be focused on is that ultimate monthly payment and how comfortable you feel paying it. Let me, your mortgage professional, do the rest. If you have any questions, or if you'd like to see just how much home you can afford, be sure to reach out to me and my team. We would love to go to work for you.